Welcome and thanks for joining this session on how bonds are priced. In this presentation, we'll break down the key drivers that determine bond values, from interest rates to market dynamics. Think of this as a practical guide that links financial concepts to real investment decisions, so you can follow how yields, risk, and time interact to set prices. When we talk about types of bonds, it helps to think about the issuer and the trade-off between risk and return. Government bonds usually offer lower risk and lower yields, corporate bonds pay higher yields to compensate for credit risk, and municipal bonds often provide tax advantages while funding public projects, making each type suited to different investor goals. Let's cover the basic concepts that underpin bond pricing. Face value is what the issuer repays at maturity, the coupon rate determines periodic interest payments, and the maturity date sets the time horizon for risk and return. The image on the slide suggests curiosity and calculation, reminding us that these simple ideas form the foundation for valuing future cash flows. Interest rates are central to bond pricing, and there's an inverse relationship. When market rates rise, existing bond prices typically fall because their coupons become less attractive. Yield curves give us a snapshot of market expectations across maturities, and tracking how rates move helps investors anticipate price shifts and align strategies accordingly. Present value is the idea that future cash flows are worth less today, so we discount expected coupon payments and principal back to the present using an appropriate rate. Discounting accounts for time value and risk, helping investors compare bonds with different payment schedules and maturities on a like-for-like basis. Yield to maturity, or YTM, represents the total return you'd get if you hold a bond to maturity, combining interest payments and any capital gain or loss. Calculating YTM involves the bond's current price, coupon, and remaining time to maturity, and it's crucial for comparing bonds and assessing how attractive a security is relative to alternatives. The pricing equation boils down to summing the present value of all future cash flows from a bond, its coupons and face value, using a discount rate that reflects risk and market yields. Understanding each component, including interest rates, timing, and risk premiums, makes the formula practical rather than abstract when evaluating real investment opportunities. Credit ratings are independent evaluations of an issuer's ability to meet obligations, and they directly affect perceived risk. Higher-rated bonds command lower yields, while lower ratings push yields up to compensate investors. Rating agencies play an influential role in pricing by shaping investor demand and the cost of borrowing for issuers in the market. Market demand and supply shape bond prices just like any other market. Demand shifts with investor preferences, income levels, and risk appetite, while supply constraints, like limited issuance or regulatory factors, can tighten inventories and push prices up. Understanding these dynamics helps explain price moves beyond pure interest rate effects. Secondary markets are where bonds trade after issuance, and pricing there reflects real-time supply and demand, liquidity, and changing interest rates. While primary markets deal with initial sales, secondary trading determines what investors actually pay, with brokers, dealers, and market makers influencing execution and price discovery on a continual basis. Duration measures a bond's sensitivity to interest rate changes, giving investors a sense of potential price movement for a given rate shift, while convexity captures the curvature of that relationship for a more accurate estimate. Together, these metrics help manage interest rate risk and build portfolios that balance expected returns with volatility control. Taxes can materially affect bond returns, so it's important to know how interest income is treated for tax purposes and how tax-exempt bonds, like some municipal issues, compare to taxable alternatives. Investors should factor tax implications into yield comparisons and financial planning to get an accurate view of after-tax performance. Inflation matters because it influences central bank policy and real purchasing power. Rising inflation usually raises interest rates and puts downward pressure on bond prices. Distinguishing between nominal and real yields helps you assess true returns after inflation, and adjusting cash flows for inflation is essential for long-term comparisons and planning. There are several models used to price bonds. Yield spread models look at differences between securities to assess risk, while discounted cash flow models calculate present value of expected payments to find intrinsic worth. Each model has strengths and trade-offs, and choosing the right approach depends on data availability and the specific pricing question at hand. Calculating bond prices starts with straightforward formulas and a clear process. estimate future cash flows, choose an appropriate discount rate, and some present values. Working through practical examples highlights common pitfalls, like misaligning cash flow timing or discount rates, and shows how to correct errors for more accurate pricing outcomes. Pricing volatility is driven by many forces. Macroeconomic events such as inflation reports and GDP surprises can rapidly shift expectations, political developments and regulatory changes can introduce sudden repricing, and market sentiment, how investors react to news, can amplify moves, creating sharper price swings than fundamentals alone might suggest. Brokers and dealers play different but complementary roles in bond markets. Brokers match buyers and sellers to facilitate trades, while dealers provide liquidity by buying and selling for their own accounts, helping stabilize prices. Understanding commission structures and trading costs is important because these fees influence the net return investors actually receive. Modern bond pricing increasingly relies on software that aggregates data, runs models, and delivers analytics. These tools can improve accuracy, save time, and support better decision-making. When evaluating pricing solutions, consider user interface, integration with market feeds, analytical capabilities, and how easily the software adapts to your workflow and compliance needs. Case studies bring theory to life by showing real pricing shifts over time, revealing what happened when markets reacted to economic or regulatory events. Reviewing historical examples helps extract lessons about risk management, the limits of models, and practical strategies investors use to navigate turbulent periods and capture opportunities. There are common myths around bond pricing that can mislead investors, so it's useful to debunk misconceptions and clarify what truly drives value. Bonds aren't always safe or predictable. Their prices are influenced by interest rates, credit risk, liquidity, and market structure, and understanding these factors leads to better decisions and fewer surprises. Pricing has direct implications for investment strategy and portfolio construction. Knowing how assets are valued helps you identify opportunities, manage duration exposure, and balance risk versus return. Practical pricing insights can guide asset allocation, inform diversification choices, and support tactics that align short-term moves with long-term goals. Regulations shape how bonds are issued and priced, with agencies like the SEC overseeing market integrity and investor protection. Compliance matters not just to avoid penalties but to maintain trust and market access. Understanding the regulatory framework helps issuers and investors operate within rules while pursuing efficient pricing strategies. International bond markets introduce extra layers of complexity. Structural and regulatory differences affect pricing across countries, currency fluctuations can add or subtract returns for foreign investors, and emerging markets often offer higher yields but with greater risk, so currency and political factors should be factored into cross-border bond decisions. Trends in bond pricing reflect broader economic shifts and policy expectations. Current market movements may signal changes in inflation, monetary policy, or investor behavior, while future predictions rely on economic indicators and expert analysis. Identifying the drivers behind trends helps investors anticipate movements and adjust strategies proactively. To wrap up, recap the key ideas. Bond prices are determined by expected cash flows discounted for time and risk, with interest rates, credit quality, supply-demand, and market structure all playing important roles. A solid grasp of pricing concepts equips you to make better financial decisions and stay adaptive as markets evolve. Now we'll open the floor for questions. Feel free to ask anything about the topics covered, from formulae and models to market mechanics. I'll aim to address audience queries clearly and break down complex issues into practical takeaways so everyone leaves with a stronger, more actionable understanding of bond pricing. For further learning, consider foundational books on fixed income, targeted online courses, and reputable financial blogs or data providers to deepen your knowledge. These resources will help you practice calculations, explore case studies, and stay current with market developments so you can apply pricing concepts confidently in real-world investing. A glossary can be a handy reference as you build fluency in bond terminology. Defining terms like coupon, yield to maturity, duration, convexity, and spread makes it easier to follow analysis and communicate ideas. Use this quick reference to reinforce learning and make complex concepts more accessible when you encounter them in practice. Please share feedback to help improve future sessions. Hearing what topics were most useful or what could be expanded helps tailor content to your needs. Continuous improvement is key, so suggestions for new themes, deeper dives, or practical exercises are welcome and will shape upcoming presentations to be more relevant and engaging. Thank you for your attention. We appreciate everyone who contributed and participated. If you'd like to follow up, contact details are provided on this slide so you can reach out with questions or collaboration ideas, and we encourage you to connect for further discussion or networking to keep the conversation going.